Hello everyone, my name is Kamal Manocha. I am CEO and founder with PMSAIF World. We have created this platform for investors, for our audience to make informed investment decisions. So this is the new webinar series that we have begun, which is by name AdviceSense webinar series. AdviceSense is our advisory and wealth management brand. So this is named on that brand name. I'll just give you the context of this entire webinar series. Investment trends are transforming from relationship-driven decisions to information-driven decisions. And because we are a new age wealth management firm, we are focused on performance and we offer quality investing, which are driven by analysis. In that regards, we have started this series, which is by name Crystal Gazing, Next Decade of Wealth Creation for Investors. So through this series, we are inviting prominent fund managers and money managers to talk about their views with regards to next decade. There are a lot of risks, there are a lot of opportunities that we know are coming up. And since we know that in this millennial, the first decade has been very good. We saw 5 to 7x returns given by Nifty and equity as an asset class. But in the second decade, which was last decade, equity as an asset class delivered a very low return. It was hardly like a debt kind of return. But in this next decade, there are a lot of promising opportunities which equities and asset class throws, because we know in today's context interest rates are very low and equities and asset class looks to be very, very promising. But attacking equity just like that is not what we believe in. Hence, we want to understand what are the risks, what are the challenges, what are the opportunities. And in that regards, today we have a very prominent guest, a well-known speaker, Mr. Hiren Ved, who is co-founder and CIO with Alchemy Capital. Welcome, Hiren, to our webinar series.
Thanks.
So we will be covering with Hiren what are his thoughts on leaders of tomorrow. And this was a first theme that we had in our minds with regards to the first topic for this webinar series, which is AdviceSense webinar series. And incidentally, we understand that Alchemy has a portfolio which also believes like that, which is Alchemy Leaders of Tomorrow. So, Hiren, first of all, I would like you to cover what is the concept, what is the genesis of creating Alchemy Leaders of Tomorrow. Over to you.
Yeah. Good evening, good afternoon, good evening to everybody. And, Kamal, thanks to you and PMS AIF World for inviting me here today for this webinar. Kamal, you rightly mentioned that equities as an asset class, the way we look at it over the next decade or so, looks to be extremely promising. And obviously, we've seen a lot of participation by domestic investors in the Indian equity markets. I think the turning point came in 2014 and then subsequently in 2016 after demonetization, where we saw a lot of flows coming into mutual funds and so on and so forth. But if you look at obviously the last 10 years, the headline indexes have not given such a great return. And having said that, in 2017-18, when we were thinking aloud as to what will make money for investors over the next 5, 7, 10 years, and a lot of thoughts came to our mind at that point in time. We had just witnessed in India a couple of very, very significant structural disruptions in the economy. It started with the demonetization in end of 2016. That was exactly the date when Trump became president of the United States of America. That was his first term. Everybody will agree, whether you like him or not, he's been extremely disruptive at a global stage, and he continues to disrupt geopolitics. He continues to disrupt how people view businesses, globalization, climate change, so on and so forth. And then coming to the Indian context, the next major disruption that we saw was in the form of structural reform like GST. As you all know, the Indian economy was largely unorganized, fragmented, uh, and many people used to do businesses which were outside the ambit of taxation. And it was like doing business in 29 different countries in India, because each state had different rules, regulation, tax laws, which made very, very difficult for businesses to think about India as one single country. But I think with the advent of GST, that changed. But GST completely shook the foundations of how business is done in India. Uh, so I would say that GST in combination with demonetization set the stage for a massive formalization of India's economy, away from fragmentation, away from small scale, to more formalization of the economy. At the same time, there was another big trend which was playing out in India, which is the internet revolution. We saw that in the last 7 to 10 years, we saw the birth of both. We saw the birth of some so-called Indian internet businesses like Flipkart. Um, we saw businesses in e-commerce. We are now seeing businesses which are spanning every segment, where technology, internet, mobile, digital is becoming the way of doing businesses, and they are disrupting traditional businesses by competing with them and reaching their customers more efficiently and effectively. Uh, so you had a lot of disruption in India which happened because of the result of demonetization, GST. Then came another big disruption in India, which is the bankruptcy code, right? So there was a time in India where if a company would not be able to pay back the bankers, you would get into very costly, long litigations, and it would take years and years before there was any resolution. But that has now changed. So with the IBC, today there is a real threat that promoters can lose their businesses if they are not able to pay up the banks in time. And therefore, that stages the way for creative destruction or pure capitalism, as we have seen in every part of the world. So I think that the order of the day over the last 4 or 5 years has been disruption, 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 disruption because of regulation, disruption because of the advent of technology, and the formalization of businesses. And that got us thinking. And we said, look, what kind of businesses will create wealth in the future? And we asked ourselves that question, that what is it that we should look for in a business that makes us confident that given these disruptions and mega trends that we are seeing, businesses will be able to capture the opportunity that the Indian market and the global market offers, and execute on that opportunity and create tremendous wealth. We've seen how the HDFC banks of the world, Infosys of the world, Asian Paints of the world have over the last 15, 20 years created massive wealth for investors. And therefore, when you talk to anybody, they would say that, we want to invest in good quality companies with good managements. Now, obviously, without doubt, you want to invest in good quality companies with good management, but is that enough for you to make money? And we thought hard and we said, you know what? Yes, all the traditional ways of looking at a business are still relevant, which is you look at growth, you look at margins, you look at cash flow, you look at return on capital, you look at return on capital, you look at ROCE, you look at debt, you look at management quality. So when we look at a business, we look at all of these, but what is it that's something special that we need to look for in a business where such businesses can thrive in the new digital world, in the new disruptive world where technology is disrupting businesses across the board? And you know what is happening globally, right? I am sure that all of you investors today by now know what FANG is, right? Which is the 5 or 6 big technology companies which have created massive wealth. I mean, Apple is today a $2 trillion market cap. Google, Netflix. Look at what Netflix has done to the media and the entertainment industry. Amazon, right? I mean, it has entered every single industry and has disrupted every industry very, very dramatically. And today, a lot of clients come to me and say, do you have a product where I want to invest in Apple, I want to invest in Google, I want to invest in Netflix, right? Why is it that investors want to invest in these companies? Because they've realized that what some of these leaders have done, the way they have disrupted businesses and created massive competitive advantages, and they are now virtual monopolies, right? And if you look at what has happened post COVID, is that the US markets have bounced back very, very aggressively, but a lot of that is largely driven by a few of these mega caps or technology companies, right? And I think this is going to be no different in every country, but India is different. So you will see some form of what you have seen with the FANGs in the US in some shape and form play out in India. And therefore, we said that we need to create a portfolio of about 12 to 15 businesses that we think will thrive in the new environment. These are companies which will disrupt. These are companies which are technology savvy. These are businesses which are built on R&D, and they possess a certain competitive advantage that they bring to the table that some of their competitors do not have, right? And therefore, we decided that we need to create a product which is different, and we called it Alchemy Leaders of Tomorrow. Now, traditionally, when you talk about leaders of tomorrow, people think, oh, it's like buying a small cap or a mid cap company which will become large cap at some point in time in the future. No, the idea here is not about buying a small cap or a mid cap or a large cap. The idea in this strategy is to look at leaders who will create tremendous wealth over the next 3, 5, 7, 10 years because they bring a certain DNA, a certain competitive advantage or an edge, which is better than other companies in the same sector, right? And I like to give this example because this is a slightly old example of the mid 90s in India, right? We all know about this cement company in India called Gujarat Ambuja Cements. Now it's called Ambuja Cement. It's now been taken over by Lafarge and Holcim. So it's become a multinational. But way back in the 90s, when it was an Indian company, it was a cement company. And it was, a commodity business. Cement is a commodity business. There is no entry barriers. If you have access to limestone, you can make cement and you can sell cement, right? But in those days, the management of Ambuja Cement thought differently, right? And they were the first company to brand cement. Nobody had thought about branding a commodity like cement, right? So in a seemingly commodity kind of a business, the management thought very, very differently. They started to brand the commodity, right? And as a result, Ambuja Cement became a brand, and it started getting a premium price in the marketplace. Even though it's a commodity, they got a premium over other cement products, right? And other cement brands. The second innovation they did was on logistics. Now, typically in a cement business, because it's a very bulky commodity, most companies were able to sell cement only within a 150-kilometer radius of where the plant was situated, because if you transport cement beyond that, the costs of logistics was very, very prohibitive. Again, Ambuja Cement, they thought very differently. What did they do? They disrupted the industry. They started to use the sea route. So, India has a big coastline. So they set up a plant near the coastline, and they put bulk cement onto shipping barges, and they transported cement to other areas in the south where cement was in deficit and prices were higher. And they had used to have grinding units there. And that is how they were able to sell their branded cement much beyond 150 kilometers, what a traditional cement plant would do. And as a result of that, they became the industry standard in as simple an industry as cement. Why? Because they created a competitive edge which nobody had thought about. And we said that if it can happen in a simple industry like cement, it can happen to any industry. But what we need is managements who think differently and are able to bring that competitive advantage to the table. And that was the birth of our strategy, Alchemy Leaders of Tomorrow. So we have created what we believe are businesses of the future. 12 to 15 handpicked businesses that we believe in the Indian context can deliver substantial returns, not just looking at traditional parameters of growth and cash flow and profitability, but we ask one important question beyond the normal questions that we ask. What is it that you are doing different? And what is the competitive edge that you are bringing to the table so that you can be successful in this disruptive world of tomorrow? So that broadly is the concept of Alchemy Leaders of Tomorrow.
Right, Hiren. Thank you for explaining this so well. So, from here on, I would want you to cover some of the examples and cover some of the themes. So my understanding is the portfolio is divided in 4 types of companies, right? So internet and digital companies, platform-based businesses, brands. So, these are some, and, science-oriented companies. So this is what, I had read. And now over to you. You can explain in detail, taking some of the examples. So some of these themes, when we hear, they definitely sound very forward looking. And when we are wanting to invest with the horizon of 10 years to build wealth, some of these themes definitely look very interesting. But as we know that when it comes to technology, if some of the today's technology companies have disrupted older players, it is definitely possible that the new technology will come and they will disrupt today's players. So this risk is always there, right? So in the older model of brick and mortar, those risks of getting disrupting was low. So for example, today when we say older companies, older thoughts like HDFC Bank, Asian Paints, right, or maybe Pidilite, or all these older type of companies which are brick and mortar companies, obviously they are also adopting new ways of doing businesses, like Nestle. So they have created so much moat that it is difficult to disrupt them.
Yes.
We understand all that. But when we are saying that, yes, everything is changing, we want to take advantage of fast disruption. And hence, you mentioned that the concept and the genesis behind Leaders of Tomorrow is based on your vision for the ongoing disruption. And hence you have figured out, so those businesses, those companies which are geared to participate and take advantage of this disruption. But obviously, there are risks also in being into these companies versus other companies which are names which I just took, like Asian Paints, Nestle, which are modes in their own context. right? So investors would want to make wealth, but they also want to be cognizant of the risks, right? So you kindly take examples and explain, why, for example, Reliance Industries at this high valuation, being enjoyed by its disruptive new way of model, right, which should continue to build wealth and should continue to grow from here on. And in that context, you can explain all your four themes and take examples. Over to you.
Yeah, thanks, Kamal. So I think, it's quite interesting when you study companies, so if you even, and, I mentioned about the FANG companies, right? And now they're called FAM with an M and G because even Microsoft is part of the FANG universe. There are only two companies which were able to, even though you may call them as the older generation of companies, but which survived, adapted, changed themselves, and became the leading companies in every decade. Because typically we see that every decade leadership changes, right? Some new businesses come and they take over, and they become the leaders of the next trend. But there are also some companies which, not all of them, but very few of the old ones, which adapt. So what you have to look for is, people talk about risk. In my opinion, what investors are taking risk is, if you only stick to the known names of the last 10-20 years, you will risk investing in some of the new wealth creators. But does it mean that we dump all the ones that have done so well in the last 10-15 years and only focus on new? No, I think it is a blend. And why a blend? Because every economy is different, right? Doing business in India is very different from doing business in the US. India is a very large country. So if you are a consumer brand and if you want to sell to India, you can't say, oh, I have an internet site and therefore I will be able to sell to every country, right? How do you fulfill? Where is your logistics? Where's your distribution? Not everything is going to be sold in India online, even though online is very, very important. And therefore, you will need to create a blend of what I call as companies, some of them which you mentioned, Pidilite, Nestle, whatever, who have created a very strong moat, but who have also adapted by using technology in their businesses so that they can survive and grow in the next 10 years and the next 10 years as well, right? So what we have done in Alchemy Leaders of Tomorrow is that we created 4 buckets or 4 broad themes that we believe were important in the investment environment in India. The first theme is companies which are based on hardcore science and technology. It is very, very important in the new world that companies use science and technology at the core of their business, right? Because which are the companies which are winning today? I mean, Apple's R&D budget is bigger than the GDP of many countries, right? I mean, that you don't achieve competitive advantage just like that. You have to be very focused on investing in research, in building new skill sets. And one of the areas we chose was science and technology in the Indian context, right? And let me give you an example. One of the businesses that we've invested is a company called Syngene. It's a subsidiary of Biocon. Everybody knows Biocon is one of the leading pharmaceutical companies in India. But Biocon has one differentiation in the sense that they were very early to get into the biotech field, into biopharmaceuticals, right? And they have a subsidiary called Syngene. Now, what does Syngene do? What Syngene does is that they work with 2 kinds of customers. They work with the big pharma majors in the world. So Johnson and Johnson, Pfizer, Glaxo, Bristol Myers Squibb. All these companies are constantly working on new molecules or new drugs that they want to bring to the market. These are their original research molecules, right? But as they know that there is a lot of R&D spending that goes into it. Now, what Syngene does is that they deliver certain R&D services to these companies to help them to create this process of new drugs faster, right? So given the fact that India has high quality scientists at a fraction of the cost, and it is not just about cost arbitrage, by the way. Yes, cost arbitrage is one of the things, but also how do you reduce the cycle time? Given that India is very good in biology and chemistry skills, lot of the large R&D life science companies would give a company like Syngene research projects to work on specific ideas, whether it is toxicity studies, whether it is taking 6 molecules and narrowing it down to 2 molecules that they think will be the winners, and do a lot of work on that, right? So Syngene is, and the second set of customers that Syngene works with is the upstart biotech companies, right? So just like in Silicon Valley, there is a lot of venture capital that funds technology companies. In Boston area, there are a lot of new age biotech companies which come up. Now, they don't have elaborate R&D labs and facilities to do R&D. And therefore, they are also called virtual biotech companies. So they may be working on one a very killer molecule, but they need a whole lot of support, to work on the lab to get that product out in the R&D into the market. So Syngene uses its scientific knowledge and the speciality that it has created is in the area of biotech. Very few companies in India can do research and manufacturing services in biotech, and Syngene is one of them, right? So, it's a young company today, 200 million revenue, but is this a company that I can envisage over the next 5, 7, 10 years can become $1 billion revenue company? I think it can become, right? So Syngene is one of them. Another company that we bet on is a company called Tata Lxc. Now, Tata Lxc is from the Tata Group. We all know TCS. TCS is very well known. It's one of the global leaders in IT services. But Tata Lxc is one of the smaller companies within the Tata Group. It's not very well known still. It's a listed company. But Tata Lxc works in 3 areas: automotive, broadcasting and media, and medical electronics. And we know all 3 industries have been disrupted globally. We know what Tesla has done to the automotive industry, right? With bringing electric vehicles, which are smart, largely software driven, and have made ICE engines history. And as a result of that, every automotive company in the world is today wanting to compete with Tesla. And we know that what Tesla has market cap has been reached, right? Now, what Lxc does is helps automotive companies to build that smart features in the next generation of cars. So self-driving vehicles, infotainment systems. Basically, going forward, 50% of the value of a car or an automobile is not going to come from moving parts, mechanical or electrical. It is going to come from software. So Tata Lxc helps these companies to build the next generation software and capabilities to make their cars smarter, right? Secondly, in media and communication, we know what Netflix has done, right? Netflix has completely disrupted the way entertainment is consumed, right? So the traditional broadcaster, the TV model is being disrupted. People are directly watching content on your phones, on your tablets, and TVs are becoming smarter. Again, all the OTT software, many of the leading OTT applications that you see in India have been built by Tata Lxc, right? Design thinking. That's the next level of thinking. How do you design a product which appeals to the customer? Tata Lxc has done a lot of work on designing, whether it is designing airports, whether it is designing a consumer product. So they bring designing. And the last area is medical electronics, right? So all medical electronics and devices, your Fitbits, your smart watches, and many medical electronics now come with IoT capabilities. So again, Tata Lxc is at the forefront in making medical electronics internet savvy. So that is one theme, right? So science and technology. Second is internet, e-commerce, mobile, and digital. That whole ecosystem is changing the way we do business, right? So you mentioned about Reliance. Look at what Jio has done, right? From an oil and gas and petrochemical company, it is now moved to the next level by creating Jio platforms. And in a very short period of time, they've been able to attract some of the best FANG companies are now shareholders in Jio. And we know that, initially they started only as a telecom company. Now it is moving to the next level with applications like GeoMart, where it will have connectivity to to the brick and mortar stores and to the mom and pop grocery stores, and you can then start to do e-commerce with them on a digital platform. Maybe you can just order your stuff on WhatsApp and it will get delivered to you. And that's how Facebook, the integration of Facebook, Google, the fact that they're even developing their own 5G technology, tells you that this company in India is one of the few companies which had the vision, and they invested behind that vision, and will be completely transformed over the next 5 to 10 years. Similarly, Bharti, right? We all know that telecom is the way to go. Everybody is, whether it is payments, whether it is money transfer, whether it is buying, the whole telecom ecosystem is going to be very, very interesting. Bharti recently tied up with Amazon for their cloud services. They got a Zoom kind of a feature by tying up with Blue Jeans. And therefore, we are going to see increasingly that the whole ecosystem of mobile, internet, e-commerce is going to create a massive disruption, and these businesses are likely to do extremely well. And the third company that we have bought in this theme is InfoEdge. InfoEdge is like the, should I say, the Berkshire Hathaway of internet businesses in India, right? So, it was known for Naukri.com, which is a job portal, but they've invested in several new age businesses like Zomato. They own the real estate listing company 99 acres. They have an investment in Policy Bazaar, which is an online insurance aggregator. So it's like a Berkshire Hathaway of the internet businesses, and they've created massive value for shareholders. And I think this is just the beginning, right? So they are likely to invest in new areas like artificial intelligence, machine learning, and they've already done that in B2C businesses, but they will do a lot of those investments in the B2B businesses as well. The third area is what I call as platforms. Now, these are platform businesses which use technology as an enabler. And what kind of businesses would come in it? Exchanges, right? You have the India Energy Exchange, you have MCX. MCX is one of our portfolio companies. It is the leading commodity exchange in India with a 90% market share, right? Even though you have NCDX from NSE, but MCX is a clear leader in the commodity exchange space, and it is all driven by software, right? So you have a technology. So whether it's a national stock exchange or whether it is MCX, these are all platform businesses which are enabled by technology. And it is quite interesting to see the combination of finance and technology, what we call fintech, as the next generation in financial services. And one company that represents that the best opportunities, Bajaj Finance. We know that in the last 10 years, that business has come, despite the HDFC banks of the world and the ICICIs of the world, Bajaj Finance built the business on data analytics, right? Their ability to crunch data for customers, their ability, and which improved their underwriting standards. Today, even though Bajaj Finance is probably 1/10 the size of HDFC Bank, but they spend more money on technology than any other finance company spends on, right? So today they were the first companies to integrate their lending solutions on all e-commerce platforms, whether it was Amazon or Flipkart. You press a button, you get 0% financing, and out you go with that, right? So the agility that some of these platform businesses have created, I think will differentiate them from other players in the world. And last but not the least, which you mentioned, Kamal, is brands. It is very difficult to create brands. So what we have done is that we've chosen companies which have either have very strong brands or ability to create brands, or ability to create categories, right? So for example, Titan single-handedly in the last 15-20 years, created jewelry brands in the organized sector, right? So they were the first one. They were the pioneers to do that. The next thing they did was with the eyewear brand by launching Titan Eye. Today, Fast Track is one of the most leading brands for the youth, right? So they sell many products from watches to belts to eyewear, bags made of Fast Track. So I think the future belongs to companies which have the ability to create homegrown brands and distribution and appeal to the young customer, right? The next millennial customer. And in India, you have several businesses in the consumer side which are still very fragmented in the unorganized sector. Another example which you gave, Pidilite, which is also part of Alchemy Leaders of Tomorrow. Why did we choose Pidilite? Because their ability to create brands, and it's almost like an Indian MNC. What they did with Fevicol, right? They don't want to their ambition is not limited to India. They want to do the same thing in the SAARC countries. They want to do the same thing in Southeast Asia and Africa, right? So you have some Indian very strong companies which have strong brands and distribution which cannot be disrupted. United Spirits is another company that we bought, right? Diageo has one of the world's best brands, and obviously, McDowell #1 is the largest selling brand or whiskey brand in the world. And it's such a complex business with so much of regulatory entry barriers. And you can today in India buy a business like that, which has 52% of India's market share with one single company. The next competitor only has a 22% market share, right? So what we decided was that, can we create a portfolio of companies, 14 to 15 companies across these four themes, right? Science and technology, internet, mobile, digital, platform companies, and brands and consumer businesses. And we believe that these are businesses which can survive and thrive in the environment which is disruptive, because they all have very strong moats. They use technology to their advantage, and they take R&D very, very seriously. And therefore, we think that these are businesses that we should own for the next 5 years and 10 years. Now, also we wanted to bring this experience because a lot of investors have come to us and said, you know what, I can't buy an Uber and I can't, participate in these businesses, but how can I do it if I want to do in the listed field? And the beauty is that you can take advantage of these businesses which are listed. So while this is almost like a private equity style of investing, but in public markets, in listed markets, you have all the liquidity, but very clearly you need to have a 5 to 10 year vision to make big money. When I first bought Bajaj Finance 10 years ago, nobody was talking about it. You could have bought an HDFC Bank at that time, right? But in 12 years, the stock has gone up 100x, right? That is what, if so, the risk you mentioned is that we've created a balance. So we've taken some very established businesses like Reliance, United Spirits, Pidilite, Titan, but companies which have adapted to the new generation. And we've also bet on emerging businesses like InfoEdge, like Tata Lxc, like Syngene, which we think are the leaders of the future, right? So it's a great combination of some very disruptive, strong existing businesses which have adapted, and new leaders which we think will create tremendous value going into the future. So that's broadly the concept behind Alchemy Leaders of Tomorrow. And as I wrote in my latest note on this product, was that the COVID crisis, in many senses, has come as a big boon to this portfolio, because more than at any time in the past, this portfolio is now more relevant, because COVID is changing the way we are doing things, how consumers are going to behave. Every business wants to go online. Unless you are able to communicate or transact with your customer online, you are able to reach him digitally, you will be left behind, right? And that's why even in a very difficult year like this year, and I will leave the whoever is interested in this, you can hand up, but especially in this year, despite a tough market, the portfolio has outperformed, because I think that in a post-COVID world, probably this portfolio and strategy is more relevant than ever that we've seen in the past. So Kamal, I'll probably end here, and I'll be happy to answer and take Q&A. I've already spoken for 40 minutes. We can spend some time on Q&A as well.
Sure. So now I'll be asking maybe a couple of questions. You can try and maybe answer in a short answers, right? So that we can cover maximum questions. So the first question, which is the common question, is that most investors, when they think of equity, they first think of risk and then think of return, and that is where they miss, and that is where they do a lot of mistakes. They would maybe not end when markets are. They will not enter when markets are low. They will over diversify their portfolio. They will enter into balanced funds. All these activities which subconsciously investors do is because they first think of risk and then they think of return. And we obviously because we are managing the advisory side, we understand this aspect, and that is the role we play, to manage the client's behavior in such a manner that ultimately things work for his advantage. But at the end of the day, it is a human mind. So in that context, I can tell you on this chat box there are most of the questions which are related to this. So the first question comes is, what are the risks which you see? Is inflation being seen as upcoming risk, or what are the risks which can lead to maybe a crash like March coming, maybe next 6 months or 1 year? Because many investors somehow, I do not know why, though we have been running these webinars since May, and I clearly remember, right, you and a lot of other fund managers have been talking about a lot of fundamental factors, and we have been giving our house view since April to be cautiously optimistic, because the fundamental factor that interest rates have come to so low levels, if we compare to 2010 as a time period, we see that next 10 years have immense potential for wealth creation in equity. But somehow, most investors have missed the bus, and now they think that they have not entered over last 2 months, they would want to maybe wait and see if market comes down 10% and then they will enter. So the question of selecting where to enter, whether it be leaders of tomorrow or older companies, that comes later. But the first and foremost question which is troubling everyone is, let me wait and then enter. So which is again, which is basically linked to human behavior, which is trying to reduce risk and not enhance return when it comes to investing in equity. So how would you address this question?
Yeah, I think first of all, Kamal, you guys are doing a good job at PMS and AIF World. As you guys are rightly called AdviceSense, right? I mean, there are a lot of people to give advice. I don't want to be one more guy who gives advice, but you have to make a sense of all that advice that people give. But you're absolutely right. I think, see, you have to understand, yes, I think all investors should worry about risk, because capital is sacrosanct, and everybody wants to protect their money and then get a return on that money. But we need to understand that there are several kinds of risk, right? One is a risk that comes because of volatility. Now, nobody knew that COVID is going to happen. And when COVID happened, the markets collapsed by 25-30%. Over time, the market has the ability to discount all kinds of risks and look forward, right? So I am not really worried about large market risks, because if you see, for the last many years, if you look at the 100-year history of equity markets, right, when the market falls 20%, 30%, 40%, eventually in the earlier years, it used to take 2 to 3 years for the markets to come back. Since the global financial crisis, central banks around the world have found this tool of infusing liquidity into the system. This whole concept of stimulus never existed before, right? But today it's a reality. And therefore, we've seen that every time there is a global risk that comes into play, the Federal Reserve or the central banks or the governments are more than eager to step in and infuse liquidity and take steps which can ameliorate that risk. So what I'm trying to say is that market risk is inherent in equity investments. You will never be able to take that risk out of the equation, because if you are in markets, then these risks will come. Who could foresee a risk like COVID? Nobody could, right? So the only way to do that is to endure that risk and have a long-term view. What is important when during these times is, what is it that you own, right? Does that lose value when risk hits the market? It may lose value for some time, but you have to differentiate between permanent loss of capital and temporary loss of value. These are two different things. So when a risk comes and people tell me, okay, you know what? So, okay, fine. So, let's say you don't invest right now, and people will say, I will invest after the vaccine comes. Okay, vaccine comes, you invest. Can anybody be sure that in 2021 there will not be some other risk that will come in? So what do? Are you going to be perpetually out of the market? I don't think that is the solution, right? The risk that you have to avoid is in investing in the wrong business. Let me give an example. In 08-09, everything fell by 55-60%. In fact, this time we are lucky that we fell by 30% and we've bounced back, right? 2008-09, the index fell by 55-60%. Many stocks fell. But by 2009 or latest by 2010, most businesses bounced back. But there were certain businesses which permanently lost money for investors. Okay, and those we all know. Reliance Communication, JP Associates, Unitech. I mean, those were all the darlings at that point in time. But when the correction came, these stocks fell. When the markets recovered, they recovered a little bit, and then they just faded away, right? Now that is permanent loss of capital. So I think what investors should fear is permanent loss of capital, not temporary loss of value. The second thing is that this thing that people have, that I will look at the index and then enter the stock market, is a fallacy. Because we know, and especially after the March correction, I'm not saying that going forward from here, markets will not correct. They can correct, right? Whether they correct 1,000 points, 2,000 points, I do not know, right? But I think that now the correction that will come will not be as secular as it was in March. Because in March, the risk was not known. What COVID is was not known to people. So what happens is that when the market is confronted with a risk that it does not know how to price, right, it reacts very violently. But now we know enough about COVID. We know what the flattening of the curve is. We have put so much of liquidity into the system. Now when the correction comes, if at all, and there will be a correction in future, not everything is going to fall at the same time. You may actually find Nifty may go from, let's say, 11,000 to even, let's say, goes 10,000, or I don't know whether it will go or not, but I'm saying, assuming let it goes to 9,500 or 10,000, not all stocks are going to fall in the same proportion. Point number one. Some stocks may fall more than the market. We have to figure out which those businesses are. And some stocks may actually go up in a falling market, which has also happened, right? So, for example, pharma stocks went the other way around. While they fell initially, but then they went the other way around. So I think that, trying to overthink about risks when you're investing for 5, 7, 10 years is a futile exercise. What you should think about is the risk that comes by investing in substandard businesses, because because of a crisis or for whatever reason, because of the company's own reason, if the stock falls, then it can never rise back. And let me give you an example. There are stocks that I invested in the portfolio, and that is why you need active managers. If you believe that something in a business has gone wrong, or there is a risk that has surfaced which can substantially impact the future earning capacity of the business, then you have to get out of that stock. You can't then say, oh, I'm a long-term investor and I will hold it till eternity. That's not what active fund management is all about. So yes, there are risks, but I think to try to look at the index and then trying to time your entry, I think is a very, very suboptimal strategy. You may lose out very good opportunities.
Right, Hiren. Thank you so much for sharing your views. One last question come again on the portfolio, which is leaders of tomorrow. So kindly give us the guidance on the forward earnings of the portfolio, number of stocks, expected churning, and maybe targeted return over next 5 years.
So, we've done the portfolio psychographics of Alchemy Leaders of Tomorrow. We all know that FY21 is going to be a very difficult year, and visibility is going to be very low. But despite that, we believe that our portfolio will not have negative earnings growth. It will still have a flat to slightly positive earnings growth. But next year, and that again, there are a lot of unknowns. But I think I would say that over the next 2 to 3 years, this portfolio should deliver a weighted average earnings growth of between 25 to 30%, right? So that's how we believe the inherent portfolio characteristics are. The portfolio's ROE is also very, very healthy. The FY20 last year ROE was about 16.5%. I think FY22 ROE is likely to be more in the range of 17.5 to 18%. So I think we've built a portfolio where ROE is substantially in excess of market averages, and I think earnings growth should be in the range of 25 to 30% in FY22 and FY23. In terms of what the returns could be, well, I think I don't want to kind of make lofty promises, but my view is that I would be disappointed if on a 5-year basis, if we are not able to compound at somewhere between 15 to 18%, right? And this is again, in my opinion, don't take it a year by year, but I think if you take a 5-year compounding, I think we should, the inherent businesses, if they can compound their earnings at excess of 20%, then I think conservatively I can stick my neck out and say that 15 to 18% compounding over the next 5 years is very much possible.
And the last point which I wanted to cover was on the expected churning in the portfolio.
No, this is not a portfolio which is going to have a very high churn. In the last 3 years or 2.5 years odd, we've possibly done just 2 or 3 transactions, right? In one case, we book profits in a technology company. So we had applied in the IPO, and then we got out of that. One where we were a bit disappointed with the way the performance was, and therefore we decided we saw very low visibility, so we got out of that company. But other than that, I think the portfolio has remained very, very steady and robust. And I would say that our churn would be possibly less than 0.2 in the portfolio, or 20%.
Right, Hiren. We had kept 1 hour for this session. Thank you so much for spending your time with us.
Well, thanks, Kamal, and thanks to PMS and AIF World and all the investors who took time out to attend this. And if you have any questions, etc., please forward them to us, and we'll be happy to answer them. Thank you again.
Pleasure. It's our pleasure. Thank you, everyone, for joining this session. Thank you.
Thanks.